Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, Lee Everett, Head of Research and Strategy at Cortland, as well as Gal Krubiner, co-founder and CEO of Nasdaq-listed Pagaya. We're here to discuss the effect on the macro as it relates to the consumer and housing, two of the most important components of what we look at in terms of economic data. It is great to have everyone with us. And Lee, that really is what the focus is on. What does the housing market look like? What's the impact of the consumer, and how economic data is going to be interpreted and moved along as we're going through, somewhat of a unsure environment right now?
Yeah, I think it's one of the more interesting times I can remember, is you really are at sort of a fork in the road where you could see either of two realities come to pass. One is this sort of stickier, slightly higher for longer, high wage growth, high housing demand, consumer sentiment rebounds as we get through this shock. And then the other one is a potential recession where you obviously have less housing demand, deteriorating consumer sentiment, and you have a true material impact. And what's interesting is both of those actually tend to lead themselves to less housing supply being built, which is not ideal for most of the consumers out there. It's an interesting road where we've had really high housing demand, really strong household formation, and we definitely have a supply cliff coming up in the near term.
Yeah, which is interesting because, Gal, when we came into the new year, the expectations around the strength of the economy and all of the excitement that was built up, certainly it showed in market prices and so forth, it feels like it went from 0 to 60 really quick. It was a pivot that I don't think was on many people's bingo cards. As you know, we're in March right now. In terms of what you're seeing with the data at Pagaya, how are you interpreting the strength of the consumer?
So maybe I will spend 10 seconds explaining what we do and how we collect the data and where we are in the ecosystem. So Pagaya, by large, is helping different banks and lenders in the United States to provide consumer credit and credit to everyone that is looking to get one and sometimes cannot get one. Part of our biggest partners that you are very familiar with are Klarna, that we have strategic partnership with them, LI Bank, US Bank, as many others, that are looking to find ways to provide more credit to consumers. And sometimes with our help, both on the funding and the AI, they're actually being able to approve many more customers. And obviously, as you said, in these days, it's even more important as we are chartering into an uncertain territory of what's the economy look like. So let me start with the first title. As we are collecting data over 31 different lenders in the US that are connected to the Pagaya network, as of now, the consumer is in a good place. Payments are coming right. The DQs, or the early delinquencies of the consumer, are at a very decent places. We have been recovered from largely a higher intense environment from the inflation that was running very hot in 21 or 22 into a place where the consumer now can afford what they are doing. Now the big question, and I fully agree with your remark and what you have said, is are we going to a place where the softening that we have seen in the consumer spending is actually being driven to become a recession, or is it just a breather to allow for them to be in a much stronger footing as they look on the economy? And that's really the question that is remaining. We don't see any signs of stress as of yet. We saw it in the Delta earnings and a few others, that their willingness of the consumer to spend go down, but the consumer ability to pay its debt is still in a very good shape.
Yeah, well, you know what's so interesting, Max? We've spoken about this with our own economic team on the desk here. There's a lot of noise in the headlines, and the data, the economic data isn't reflective necessarily of that, and that goes back to Gal's point of the consumer staying engaged. It's been tough to bet against the consumer.
Yeah, for sure. And I try to take every new data point that comes out every week kind of just as a piece of a whole, because any one singular data point where you see these big reactions and then we see a revision a month later, 2 months later, you kind of need to see the broader trends versus the individual data points. Every time we think there's been weakness, the consumer has been there. Now, we're starting to see sentiment, start to dip, spend come in a bit, retail sales, but it's more of a rotation, like you said. It's not the inability to spend, it's kind of changing where you spend instead of going out to restaurants as much or travel, kind of rotating it to kind of more your staples type names, things you need. The ability to pay, though, like you said, is still there. Not really seeing an uptick in delinquencies. Now, in some of the housing market, it's starting to tick up. You start to see a lot of charts of, okay, look at the delinquencies picking up, but when you kind of zoom out and go back in historical numbers, it's really not that big of a deal at this point. Now, again, like I said, there's just so much uncertainty right now. Is it a one-time shock? Do the tariffs stay in place? Do they come off? Do we have reciprocal trade? There's so many unknowns that at least at this point, it feels more just like a breather.
Yeah.
And saying, okay, let me just reevaluate. Instead of dumping money into either the market or going out spending on travel, let me just be more sure of kind of what we're doing here before I dive in.
And if I may, to these
Yes, of
points, I think two parts which are very interesting for that. Number one, employment is key.
Right.
Employment is the most important piece. Thankfully, we are starting to go in this environment where employment is all-time low. So there is a buffer of how much the U.S. economy could absorb as we talk about that. And if we just listen to Powell a few minutes before we came to this talk, it's clear that there are some signs of this shift that you're talking about. But the more important is the robustness of the equity that they have in their homes and other places, right? And the ability of employment to be in a strong footing. And that, I think, is something that very important to remember, because you might see a little bit of a spike, but you're starting from a very unique place where there is still a lot of room to reduce rates, to help the consumer. So I will say that the news like to be a little bit more noisy, as you say, than the actual data. Might be the data is lagging, and might be that actually we are in a little bit softer environment, but still very manageable.
But when you're hearing chaotic uncertainty all the time, we know that there's going to be, light at the end of the tunnel here. But Max, what's so interesting is prior to this panel, we know that there's a lot of cash on the sidelines within the traditional market space. I just did a digital asset panel. There might be rotation, but they're not leaving the digital asset market.
Yeah.
They're putting it stablecoin, staking, doing whatever. So the interest is there. The fundamentals are okay. Again, it's getting through that noise.
Yeah, and tether minting, a ton more. We also just saw some new data coming in about retail this most recent time, not buying the dip. So again, it's more that kind of cautious, that everything's kind of being left in there. We're not really seeing an exit for liquidity. Everybody's trying to raise capital. It's okay, maybe my incremental dollar, instead of investing it, I'm going to hold on to it for a little bit. The interest is still there. Again, if we really saw a rush to the exits, right now it's just a correction, right? We're 10% off all-time highs. Markets have been, on an absolute heater the past few years. Taking a bit off the table, okay. If it was really a rush to exit and taking off all leverage, I think it would have been a lot sharper of a pullback. We're starting to settle in a bit. So like you said, it's kind of there. Let what you have in the market continue to work. But again, it's maybe that incremental dollar is just a bit more cautious, where you're not really seeing everything being pulled out. Everything is still working. It's not like there's this cliff we're about to walk off of. It's okay. Let me just reevaluate things. We've really had a really strong run in the last few years.
Right.
Maybe just take a quick pause and see how things.
I think even take a step back for a moment. 4.1%, 4.2%. Those tenths of a percent does not mean the employment market is falling, out from itself. And again, digesting those headlines and being able to read through the noise. But you talk about a stagflation scenario here. If we experience that, why would that be the worst case scenario?
High interest rates, slowing growth is ultimately the worst case scenario in the housing world. And I mean, I think to take it a step back to sort of talk a bit about the broader economics, I think what's driven a lot of this sort of soft landing has been this unique scenario where the baby boomers are massively exiting the workforce, but they're also consuming an absolute ton. So that's where the consumer sentiment numbers and such matter to me, as if they decide they want to protect their wealth, protect their housing equity, not sell their homes, sit where they are and weather the storm, that's where I think weakness could start cascading. And that's where if they're not spending, you can have cracks downstream in the labor force. Look at where you've had the strongest labor needs: retail and hospitality, service industries, airfare. As those cracks can move downstream, you get pain in the housing market. That's where in stagflation, you can get stuck with sort of this higher interest rate environment, decreasing demand, decreasing economic growth, and ultimately, that's not something we've seen for 50 years in this country, and no one can build, you have a lack of housing demand, cost to build remains high, and you're just almost stuck because you either have an increasing rate environment to force a larger recession to dig out of the hole, or you are stuck in a sort of declining but expensive limbo.
You know what, anecdotally, and again, I'm not a housing expert, it feels as if I've seen houses on the market 60, 90 days, pull them back, adjust the price, or it's just staying, it's taking longer to go into contract. Or it used to be, I mean, at least when Max and I bought a house in 2021, I mean, you had to get that done within days. It feels a little bit different.
Yeah, and it's definitely changing. And we had a reasonable single family starts number come in this month, but at the same time, you listen to any of the builders' earnings calls today, and what do you hear? Increasing incentives, longer time to move more inventory sort of backing up in the backlog, and that translates down the calendar to a decrease in supply from those builders if you don't have a beginning to purchase again. Because anecdotally, I'm experiencing the same thing in my neighborhood, and then we have the backup from the new home builders. And frankly, the affordable access to housing today is those new homes, because the builder incentives, the buy downs on rates, that's where people can enter the housing market easiest.
Yeah, and Gal, you brought up an interesting point in your notes here that you're seeing demand from the private credit side as well. That's been a very consistent theme.
So I think definitely to what Max said, like liquidity is out there. Liquidity is out there, and there is a bid, not just for equities, but for consumer credit, and for various different asset classes, more going into the alternatives, which were less the mainstream, call it 10 years ago. But like we are in an economy that is functioning, in markets that are functioning. And when you have usually these events, even if you have a shift in tectonic places of what people like more or like less, it's less ending up in a collapse. If you look on the last 10, 15 years, maybe even 20 almost, 25, it always comes when there is the dot-com boom, like when everything is running too fast, too high, and then collapsing. You had the 2008 financial crisis when you bought and sold the home in 2 days in between, and then it's getting to an end. It was because of a pandemic. So as much as we think we're living now in an uncertain world because we don't know yet where the tariff is going to land, we know that tariffs are an issue, and companies have the ability to adjust as long as they know. So if there is a big message I think that we need to give to the audience is that we need to look on how these tariffs are landing in the next months or so. We will see adjustments that are happening across, in the housing, in the consumers, in the companies, in the demand. And as long as it is predictable, the US economy has a rather good ways to work it out. But if it's going to be now a years of uncertainty and every few months something new is coming, that's going to be much harder to collaborate.
Yeah, but you know, I agree with your point there, because the past 5 years between everyone having to migrate to cloud, oh, and then by the way, everyone's working from home, and then we had an election in between there as well. I think companies from a fundamental perspective operated quite well. And if they can navigate, you know, a 100-year pandemic, migrating to cloud, you know, a contentious election in between there as well, Max, this goes back to our points that the fundamentals are still quite strong.
Yeah, companies have proven to be agile and adaptable. There's new wrenches thrown in constantly. It's okay, it's the initial shock. People then have to figure out, okay, how are we going to manage around this, manage through it? You know, companies always talk about it, not, you know, focusing so much on the next day, but managing through cycles, you know, looking 4, 5, 10 years out. There's going to be bumps in the road here and there, but if you continue to execute your business, there's no existential threats like you're talking about where it's really collapsing. And even now, when you compare, there's a lot of comparisons recently with AI, you know, bubble, AI hype to, you know, the dot-com bubble. The reactions, Mag 7 are lower now so far this year, but again, the returns for the past few years have been so great, and we're not just seeing this cascading exit, everybody leaving. There's real growth there. You know, NVIDIA just had their conference yesterday, today. There's still bullish trends and, you know, tailwinds for corporates, and they don't seem to be getting overly consumed in the minutia. We talked about it with rates for, you know, the last few years of companies kind of kicking the can down the road. You know, higher rate environment. We thought it was going to be, you know, a bit shorter term than it has ended up being. You know, we're still in the kind of 4% range for, you know, for treasuries. Companies have been able to manage through it. We've still had earnings growth. You know, we still have positive reports despite everything that's been there. So again, these short-term headwinds, companies have been, you know, agile enough to get through it and continue to operate and execute. And like you said, labor is still very strong. We start to see that change. That's something to, you know, keep an eye on. We're seeing some headlines, you know, kind of reorganizations or, you know, streamlining certain things, but it's not across the board. We're seeing job cuts everywhere. It's, you know, it's a big concern.
I would say another point to this. I think actually over healthy all the time economy is actually not healthy, because then the weak ones are just staying there and surviving, although they're not good. When you have challenges, days and times where companies that do not have a good business model and should be out of business and should, you know, make room for others that will be more appealing and more strong, it is an important piece. We know we hate short-term pain, all of us as human beings, but that's how you balance out a real long-term growth.
Yeah.
And it's important to know that.
Well, we were talking about that in the digital asset space, but applying the same kind of concept, Lee, from, you know, the macroeconomic lens. You have to remember too, recency bias, and there is a generation of investors and home buyers out there who have never experienced a prolonged environment of, you know, volatility since the great financial crisis, and of course since then there was so much liquidity that was inserted into the market that, from a historical perspective, rates aren't, you know, that terrible. I get the increase in the home prices, what counterbalances that, but I think recency bias of buying the dip and always this expectation that there will be a return. We need to exercise some patience and understand, you know, 7-8% in the market on average year over year is not a bad thing.
Yeah, and what's interesting about that, though, is, at least in the housing sphere, particularly multifamily, in the higher rate environment economies, the 90s, the early 2000s, which in theory were more similar to today than last decade, you had much higher yields or cap rates on multifamily housing investments. So people were generally getting much higher returns. We've really institutionalized the space over the last 20 years. So as capital has flooded it, to my friend here's earlier point, and there's still plenty of dry powder out there, you've seen those returns and the spreads to your risk-free rates very much compressed. So where there's pain now is they compressed to the point in 2021 and 2022 where people were essentially buying with negative leverage, and they were buying financing rates that were as low as, if not lower than, the yields. And that's where there's delinquencies and pain, and a lot of this was non-institutional, new entrants to the market that were fundraising on social media type of players, but it's a very real reality that we saw yields dip to an unhealthy level in the multifamily space coming out of the pandemic, and it was overexuberance and an overabundance of capital that did lead to that, and that's where that pain of adjusting to this more historically normal but forgotten about environment has really hit the
Yeah, I mean, that's like, you know, our mortgage rate is it was lower than our savings rate.
Yeah, and that goes to your point, though, of there's people, investors, companies that, you know, we talked about it for years, zombie companies that when, you know, rates are at zero and you have free money and it's
everything goes.
It's revenue at all costs. It doesn't matter if you're profitable, revenue, that's the focus. And then you don't have a profitable business model that's actually going to work in the future. Maybe you shouldn't actually be there. And we need to be able to churn those out and bring in, you know, move that capital from one place to more efficient, you know, places.
Yeah, and the last 30 seconds here, Gal, if you could wrap up your thoughts.
So I think we're in interesting times. We should pay more attention to the data rather than to the headlines, and to be able to understand that we are living in a world where not everything is perfect, but it doesn't mean that everything is terrible. And how to navigate that, the stronger will survive, and Pagaya will be there to lead the way.
What is it, The Godfather? Over 5-10 years, these things need to happen. All right, guys, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.